Hey everyone, welcome back to Gold Rush Reporter, your trusted source for deep insights into the world of gold and silver. I'm your analyst Hashir, and today we're diving into something truly fascinating, a major shift happening in the global power structure that could redefine the future of money, trade, and precious metals. Before we get started, make sure you like this video, subscribe if you haven't already, and hit that notification bell so you don't miss our next deep analysis. And I'd love to hear your thoughts down below. Do you think gold will become the foundation of the next global financial system? Let's discuss. All right, let's get into it. What we're seeing right now isn't just about gold prices moving up or down. It's about who controls the world's financial future. For decades, the United States and its allies have dominated the global economic system through the US dollar, which has served as the world's reserve currency. But in recent years, a major transformation has been unfolding quietly behind the scenes, led by nations like China, Russia, and members of BRICS. These countries have realized that the dollar's dominance gives Washington too much power. When the US can sanction any country at will, freeze assets, or block trade through the SWIFT network, it creates a motivation for other nations to build an alternative system. One that doesn't rely on the dollar at all. And that's exactly what we're witnessing now. China has been leading this effort by forming strategic gold partnerships with countries like Saudi Arabia, Russia, Iran, and even parts of Africa. Beijing understands that to replace or challenge the dollar, you need more than political alliances. You need trust, and historically, that trust has always been backed by gold. Now here's the interesting part. For decades, the West has treated gold as a financial asset, something to trade, speculate on, or hold in reserves. But for the East, especially countries like China and Russia, gold is money itself. They're not just buying gold, they're rebuilding a monetary foundation. China's creation of the petro-yuan, which allows oil trading in yuan instead of dollars, is one piece of that puzzle. But now, with increasing physical gold accumulation and the potential to back the yuan with gold reserves, we're talking about the return of something the world hasn't seen in nearly a century: a gold-linked currency system. This could explain why central banks have been buying gold at record levels. In 2023 alone, global central banks purchased over 1,000 tons of gold, the highest in modern history. That's not a random coincidence. It's a signal that governments are preparing for a post-dollar era, one where gold plays a central role again. So when you see headlines about gold hitting new highs or central banks quietly hoarding bullion, remember, this isn't just an investment trend. It's a geopolitical realignment. China's strategy with gold goes far beyond simple accumulation. It's a carefully engineered blueprint to reshape the global financial system. For decades, the West, led by the United States, has operated on a system where the US dollar was backed not by gold, but by trust. Trust in the US government, its economy, and its political stability. But that trust has been eroding. Trillions in debt, endless money printing, and rising geopolitical tensions have all contributed to growing doubts about the dollar's long-term strength. China recognized this weakness early. While the Western world was focused on debt-based growth and digital finance, Beijing was quietly executing one of the largest gold accumulation programs in modern history. Officially, China reports around 2,300 tons of gold held by the People's Bank of China, but analysts believe the real number could easily be 2 or 3 times higher. That's because China's state-owned banks and the military are known to hold additional unreported reserves. This hidden buildup gives China immense leverage. In a world where paper currencies can lose value overnight, gold remains the ultimate equalizer. By anchoring its financial system to real physical gold, China is creating a foundation that can't be easily manipulated by sanctions or political pressure. It's also building trust among trade partners, especially nations in Asia, Africa, and the Middle East that have grown tired of Western control. We're already seeing the early signs of this shift. The Shanghai Gold Exchange, for example, has become one of the world's most important trading hubs, giving China direct influence over the global price of gold. Unlike the COMEX or LBMA, where trades are mostly paper-based, the Shanghai market deals heavily in physical gold, a crucial difference. This ensures that prices reflect actual demand and supply, not leveraged futures contracts. Then there's the BRICS alliance, which has evolved from a loose economic group into a genuine alternative power bloc. Their recent discussions about a BRICS currency, potentially backed by gold or a basket of commodities, show just how serious they are about reducing dependence on the dollar. Russia, already cut off from Western banking systems, has strongly supported this move, while China provides the infrastructure and financial muscle to make it possible. And this isn't just about politics, it's also about trade efficiency. Gold-backed trade settlements could eliminate the need for dollar conversions, reducing transaction costs and currency risk. Countries like India, Saudi Arabia, and Brazil have already shown interest in these mechanisms, especially for energy trade. The result? The dollar's monopoly on global oil and commodities trading, the so-called petrodollar system, is slowly being replaced by what some are calling the petro-gold era. From an analyst's perspective, this is monumental. It means that the financial world is beginning to pivot from paper promises to tangible assets. And that's where the East has a massive advantage. While Western nations have been selling off gold reserves for decades, Eastern nations have been accumulating them, quietly, strategically, and with long-term vision. In essence, China isn't just preparing for a new monetary order, it's designing it. And gold is the key that unlocks that future. As China and its allies continue to expand their control over global gold markets, the impact on precious metals prices is becoming impossible to ignore. For years, gold and silver prices have been heavily influenced by Western institutions, particularly the COMEX and the London Bullion Market Association, LBMA. These are markets dominated by futures contracts, derivatives, and paper trading, meaning that for every ounce of physical metal that exists, there could be hundreds of paper claims representing it. But what happens when real physical demand starts to overwhelm that paper system? We're starting to find out. The recent backwardation in silver, where spot prices are higher than future prices, is a clear warning signal. It tells us that buyers want metal now, not in some distant contract months ahead. This is highly unusual and points to serious tightness in physical supply. China's actions have played a huge role in creating this environment. Through its gold imports, refinery operations, and the Shanghai Gold Exchange, it's been quietly siphoning physical bullion out of Western vaults. Each bar that leaves the LBMA or COMEX system and ends up in Asia is a bar that may never return. Once gold and silver flow east, they're typically melted down into kilo bars, the preferred format for Asian buyers, and stored locally. That means less liquidity, less availability, and ultimately more pressure on Western inventories. Silver, in particular, is in a unique position. Unlike gold, which is largely hoarded, silver is both a monetary and an industrial metal. It's essential in solar panels, electric vehicles, 5G technology, and countless electronic components. As global industry moves toward electrification, the industrial demand for silver is exploding. Meanwhile, global mine supply has been stagnant for years, with many silver-producing countries facing declining ore grades and higher extraction costs. This is why analysts are starting to issue bold new forecasts. We've seen major institutions like Bank of America, Morgan Stanley, and Jefferies dramatically revise their outlooks. Bank of America now projects silver could reach $65 per ounce next year, while gold could surge toward $5,000 or even $6,600 per ounce, according to some traders. These aren't just wild guesses. They reflect a growing awareness that the world's monetary foundation is shifting. When you connect the dots, backwardation, record lease rates, and the mass transfer of physical metal to the East, the picture becomes clear. The era of suppressed metal prices is ending. Western financial institutions that once controlled the pricing mechanisms are losing influence, and Eastern buyers who value real assets are taking over. This transition doesn't just affect prices, it affects confidence. For decades, investors believed that the gold and silver markets were stable, predictable, and well supplied. Now we're witnessing cracks in that illusion. The LBMA's declining stock levels, the rising cost of borrowing silver, and the increasing premiums for physical delivery all indicate systemic stress. Even high-level financial strategists are beginning to acknowledge the shift. For the first time in modern history, major institutions are recommending gold allocations of 20% to 25% in diversified portfolios. Just a few years ago, that would have been unthinkable. Now, it's becoming mainstream advice. As a silver analyst, I believe this reflects a deep understanding among the world's elite investors. They see the writing on the wall. Fiat currencies are losing credibility, debt is spiraling out of control, and real assets like gold and silver are once again being recognized as the foundation of true wealth. The idea that gold could soar to $20,000 per ounce might sound extreme, but when we dig into the logic behind it, it starts to make a surprising amount of sense. If such a revaluation were to happen, it wouldn't necessarily mean gold has become wildly more valuable. Rather, it would mean the dollar has become far less valuable. It's all about relative value. Financial analyst Luke Gromen argues that if gold were to hit $20,000, it would simply bring it back in line with the ratio of US foreign debt and official gold reserves, effectively restoring the balance that existed decades ago. Back then, the US dollar was backed by a credible gold position. Today, that balance has been lost, as America's debt has exploded while its gold holdings have remained flat. Here's where things get interesting. At $20,000 an ounce, the Treasury's gold reserves would suddenly be worth about $5 trillion, enough to inject that amount directly into the Treasury General account, free and clear, as Gromen put it. This would provide massive financial relief to the US government, allowing it to stabilize its balance sheet without selling a single bar of gold. In accounting terms, it would be one of the most powerful revaluations in history. But it's not just an accounting trick. It would represent a complete restructuring of the global financial system, one where gold reclaims its historic position as the foundation of monetary confidence. This shift is already being set in motion by the collapse of the post-1971 dollar system, where US treasuries replaced gold as the world's reserve asset. That system worked for 50 years, but now cracks are appearing everywhere. The turning point came when China cut off rare earth supplies to Western defense industries. It was a signal that the world's manufacturing and resource powerhouse was ready to leverage its economic strength strategically. That single move forced Western nations to confront their own vulnerabilities. Suddenly, the United States and Europe found themselves dependent on nations that are now aligning under the BRICS banner, pushing for a multipolar world order, backed by commodities rather than credit. This geopolitical shift coincides perfectly with the financial one. Central banks around the world are dumping US treasuries and accumulating record amounts of gold. In fact, gold holdings among central banks have surpassed treasuries for the first time since the early 1970s. This means that, whether they admit it publicly or not, these institutions are treating gold as the true reserve asset once again. Meanwhile, the US dollar remains the world's medium of exchange, but its purchasing power is eroding steadily. As Luke Gromen points out, the dollar and gold can actually rise together during the transition phase, something predicted decades ago by monetary theorists known as another and friend of another. Their analysis suggested that when both the dollar and gold rally at the same time, it's the final stage before the dollar-based financial system resets. And that's exactly what we're seeing today. The milkshake theory, proposed by Brent Johnson, also predicted this dual rise. The theory explains how global capital would initially rush into the dollar, pushing it higher, before the system eventually collapses under the weight of its own debt. In that collapse, gold becomes the ultimate escape hatch, the asset that covers the liabilities when everything else fails. If the price of gold continues to climb beyond $3,000 and then $5,000 per ounce, the US Treasury market will begin to destabilize. Dollar liquidity will dry up, bond prices will fall, and nations holding US debt will be forced to sell off assets to raise capital. This could trigger a domino effect that leads to massive capital flight into gold, not out of speculation, but out of necessity. At that point, gold wouldn't just be an investment, it would be a lifeline for the financial system. It would absorb the world's excess debt and provide the collateral needed to rebuild trust in global markets. That's why major analysts believe gold is not just going up, it's being repositioned as the backbone of a new monetary order. If we really step back and look at everything that's happening, the rise in gold prices, the dollar showing cracks, central banks hoarding metals, and the BRICS nations forming a united front, it's clear that we're not watching a random market fluctuation. We're witnessing the slow, deliberate reset of the global financial system. Every signal points in the same direction. Gold is being restored as the foundation of global value, and the age of unlimited fiat expansion is reaching its limit. Now let's think about what a $20,000 per ounce gold price truly represents. It's not fantasy, it's math. The US debt now exceeds $35 trillion. If gold were revalued to $20,000, it would simply bring the nation's gold holdings back into proportion with that debt. That's why analysts like Luke Gromen believe this isn't about speculation. It's about accounting reality. When that revaluation happens, it could instantaneously add trillions to the Treasury's balance sheet, offering short-term relief, but also confirming one undeniable truth. The dollar-based era, as we know it, has peaked. Meanwhile, silver, gold's historical companion, won't stay quiet during this transition. Silver tends to follow gold, but with greater volatility and leverage. If gold truly climbs toward $10,000 or even $20,000, silver could easily explode past $200 or even $300 per ounce. Why? Because silver isn't just a monetary metal, it's an industrial one. It's used in solar panels, electric vehicles, and advanced technology. So, As the global economy tries to rebuild around sound money and sustainable energy, silver could become the most strategic metal on Earth. This is the moment when smart investors and analysts stop thinking in terms of monthly price charts and start thinking in decades. The long game here is wealth preservation. Whether you're holding physical metals, mining stocks, or ETFs, the goal is to protect purchasing power as currencies lose credibility. Because once gold becomes the central reserve asset again, the rules of the financial world will change. And those who prepared early will be the ones holding real value. We are now in the early stages of that shift. Every day that gold climbs by $50 or $100, we're watching the old system crumble just a little more. This isn't panic, it's transition. The dollar won't disappear overnight. It will continue to function as the world's medium of exchange, but its store of value role is being quietly replaced. The world is moving toward a multi-asset, multi-currency system, and gold is leading that move, with silver right behind it. So, the key takeaway today is this. Don't get distracted by the daily price noise. Look at the pattern. Look at who's buying. Central banks, sovereign funds, and private institutions, they're all telling you the same thing through their actions. The next global reserve system is already being built, and it's built on hard assets. If this analysis helped you see the bigger picture, make sure to hit that like button, subscribe to the channel, and turn on the notification bell so you don't miss our upcoming reports. We break down these complex moves in simple terms every week, right here on Gold Rush Reporter. As always, thank you for watching and being part of this growing community of gold and silver believers. Stay smart, stay informed, and I'll see you in the next video, where we'll continue to track this historic shift toward a new era of sound money.